Hi and Assalamualaikum warahmatullahi wabarakatuh. This is our group member which will explain for topic acquisition and payment cycle. First is Alia Shahira, second Nur Shahira Adrana, third is Hani Zalila and Nur Ain Akila. Before we go through, we need to know what is the acquisition and the payment cycle. The acquisition and payment cycle is the process and transaction related to the acquisition of good and service and the subsequent payment for those good and service such as raw material, equipment, supplier, utility, repair and maintenance, and research and development. Next, there are two audit objectives related to the association. First is to evaluate whether the account effective by acquisition of goods and service. Second, the cash disbursement for those acquisitions are fairly presented in accordance with the accounting standard. Let me explain the management assessment related to the acquisition and payment cycle. First is occurrence. Is the transaction and event that have been recorded and disclosed have been occurred, and such transaction and event pertain to the entity. Audit objective to check whether all the recorded acquisition actually occurred and were acquired. Second is completeness. Completeness is all transaction and event that should have been recorded and all related disclosure that should have been included in the financial statement. The audit objective to ensure acquisition are recorded in correct account and categories. Next is accuracy. Accuracy is amount and other data relating to the recorded transaction and event have been recorded appropriately and related disclosure have been appropriately measured and described. Audit objective to verify the acquisition transaction are recorded in the correct amount. Next, cut-off is transaction and event have been recorded in the correct accounting period. Audit objective to ensure acquisition are recorded in the correct account and categories. Last session is classification. Transaction and event have been recorded in the proper account. Audit objective to ensure acquisition are recorded in the correct account and categories.
There are three classes of transaction, namely education goods and services, cash disbursement, and purchase return and allowance including purchase discount. I will explain this transaction in relation to the relevant hesitation. So first, I will explain execution of goods and services related to the hesitation. For the occurrence, to ensure that all recorded purchases of goods and services actually occur and were properly authorized by the management, the auditor will verify the existence of the transaction to avoid recording duplicate purchases that can miss the accounts. For example, the auditor examines the purchases order, reserve report, and supplier invoice to confirm that an office computer purchase worth 5,000 was genuinely reserved. For the completeness, to ensure that all purchases of goods and services that occur during the accounting period are fully recorded. Omitted purchases under the expenses or liabilities. The auditor must verify no valid transactions are missing. For example, the auditor reviewed December reserve reports to confirm all purchases are recorded in the purchases journal before period and closing. Lastly, for the accuracy, to ensure that the amounts and detail of recorded purchases are accurate and consistent with supplier invoice and other supporting invoice and documents. If have errors in amount can lead to misstated expenses. For example, the auditor compared the supplier invoice showing 200 units at 1 ringgit to the total amount 200 with purchases journal to ensure that recorded amount match exactly and no errors such as 250 are recorded. Next, I will present cash disbursement related to the execution. For the incurrence, to ensure that all recorded cash disbursement actually occur, it is because the auditor can verify that payments were made legitimate and authorized purchases. It is can help to prevent fraud payment to fake vendors. For example, the auditor review payment voucher, check copies, and bank statement to confirm a 10,000 payments to a supplier match the purchases order and vendor invoice. For the completeness, to ensure that all cash disbursement made by the company are fully recorded in the accounting system. Missing entry could overstate accounts payable or understate expenses. The auditor check to ensure no payment is omitted. For example, the auditor can trace all payment from the bank statement to the cash disbursement journal to verify that every payment has been recorded. For the accuracy, to ensure that the recorded payment amounts are accurate and match supply invoice and supported documents. Error on your recording can lead to misstated financial statement. The auditor must compare documents to verify the correct amount. For example, the auditor will match the amount recorded in the cash disbursement journal with the supply invoice and payment voucher to ensure no overpayment. For the purchase return and allowance, included purchase discount related to the execution are accurate. To ensure all recorded purchase return, allowance, and discount actually occur and are valid, it is because can prevent the company from recording fake returns or discount to understate purchase costs. The auditor can review supporting documents such as debit or credit notes from supplier. For example, the auditor examines a supplier credit note showing the return of 50 damages unit worth 1,000 to confirm the transaction genuinely occurred. For the completeness, to ensure that all purchases return, allowance, and discount that occur are completely recorded. Failing to record them leads to overstate purchase costs. The auditor can verify that all supplier credit notes are fully recorded. For example, the auditor traced all supplier credit notes received to the purchase return journal to ensure none were omitted from the records. For the accuracy, to ensure that the amounts for purchase returns, allowance, and discount are accurately recorded supplier documents. Error in amount affect the accuracy of purchase cost in the financial statement. The auditor can compare credit notes value with recorded entries. For example, the auditor will match supplier credit note showing 2,500 with the purchase returns journal to ensure it is recorded correctly without errors such as 2,800. After that, I will talk about the relevant account or ledger related to the execution. For the occurrence, the account help confirm whether a transaction really occurred. This entry must be traceable to real event. For example, a 3,000 ringgit payment in the bank account must watch a supply invoice and account payable. For the completeness, this ledger ensure all valid transactions are captured and nothing is left out. For example, if goods are reserved, the inventory and purchases account must show the entry, otherwise it is incomplete. For the accuracy, this account show whether the right amounts were recorded based on correct pricing and quantity. For example, a vendor invoice state 1,200 but the purchase account show 1,500. This overstatement is sign of inaccuracy.
Now, I will be presenting the audit procedure and the internal control for the purchase and payment cycle, which is a critical area in transaction relating auditing. Let's begin with a quick overview. Internal control is defined as a process that is designed and influenced by those in charge of governance and management. Its purpose is to provide reasonable assurance that the entity objectives, especially regarding financial reporting, are achieved. For the purchase and payment cycle, internal control mainly focuses on 4 areas. First, proper authorization of purchase. 2. Separation of asset custody from other functions. 3. Timely recording and independent checking of purchase and payment transactions. 4. Proper authority for payment. This control helps prevent fraud, detect error, and ensure transactions are recorded accurately. For existing, our objective is to ensure that the recording purchase are for good or service that we actually receive. The key internal control here is proper approval and cancellation of document to avoid reuse. As an auditor, we check for approval, signature on purchase order and invoice, and confirm cancellation marks. Substantively, we examine supporting documents such as delivery notes and invoice, and review the vendor master file for any unusual or suspicious vendor. Next is completeness. Here we want to confirm that all purchases are properly recorded. The company should use pre-number document like purchase order and receiving report, and ensure all documents are accounted for. In our test of control, we trace the sequence of purchase order and receiving report and look for any missing number. As substantive procedure, we trace from receiving report to the purchase journal and match invoice to journal entry. Date, accuracy. This ensures that purchase amount are correctly recorded. Internal control, such as verification of amount and batch totally, are important. We check for evidence of verification like initial or review, mark and match total to system report. Substantive procedure involve matching journal entry to supporting document and recalculating amount of invoice. Fourth, classification. We need to ensure transactions are recorded in the correct account. Companies should use a proper chart of account and verify classification. As an auditor, we check that the classification is approved and correct. We compare classification in journal with vendor invoice and the chart of account. First, the timing. It's crucial that purchases are recorded in the correct accounting period. Internal control include prompt recording and verification of transaction date. We check the procedure manual and investigate any incorrect, unrecorded or late invoice. Substantively, we compare invoice date and receiving report date to journal entry date. Last but not least, posting and summarization. This relates to whether purchase transactions are accurately posted to the ledger. Key control included independent review and posting verification. We check for initial on posting document as part of the test of control. Substantive tests include footing the journal and tracing amount to the ledger and account payable or inventory master file. In conclusion, understanding this internal control and applying the right audit procedure is essential to ensure that the financial statements are free from material misstatement. Each assertion must be supported with a strong evidence from both control and substantive testing.
Next, transaction-related audit objective, common test of control and common substantive test of transaction for cash disbursement. For existence, the objective is the recorded cash disbursement are for goods and services actually received. Key internal control, supporting documentation is examined before signing of checks by an authorized person. Common test of control, the auditor discuss with personnel and observe the activities. For common substantive test of transaction, auditor can trace the cancelled checks to the related acquisition journal entry and examine for payee name and amount. For completeness, the objective is existing cash disbursement transaction are recorded. Key internal control is the bank reconciliation is prepared monthly by an employee, independent of recording cash disbursement or custody asset. For common test of control, auditor can examine bank reconciliation and observe their preparation. For common substantive test of transaction, the auditor can reconcile recorded cash disbursement with the cash on the balance sheet. For accuracy, the objective is to make sure the recorded cash disbursement transactions are accurate. Key internal control, the bank reconciliation is prepared monthly by an independent person. For common test of control, the auditor can examine bank reconciliation and observe their preparation. For common substantive test of transaction, auditor can compare cancelled checks with the acquisition journal and cash disbursement journal or recomputed cash discount.
For classification, the objective is to make sure the cash disbursement transactions are properly classified. Key internal control, account classification are internally verified for common test of control. The auditor examines indication of internal verification. For common substantive test of transaction, the auditor can compare classification with chart of account by referring to vendors' invoices and acquisition journal. For timing, the objective is to make sure the cash disbursement transactions are recorded on the correct dates. Key internal control procedure require recording of transaction as soon as possible after the check has been signed. For common test of control, the auditor can examine procedures, manual, and observe whether unrecorded checks exist. For common substantive tests of transaction, the auditor can compare that on cancelled checks with the cash journal. For posting and summarization, the objective is to make sure the cash disbursement transactions are properly included in the accounts payable master file and are properly summarized. Key internal control, accounts payable master file or trial balance totals are compared with general ledger balance. For common test of control, the auditor can examine initials on general ledger accounts, indicating comparison. For common substantive test of transaction, the auditor can test clerical accuracy by footing journals and tracing posting to general ledger and accounts payable master file. Next, balance-related audit objective and test of details of balance for accounts payable. For existence, the objective is to make sure the accounts payable in the accounts payable list. For common test of details of balance, the auditor can trace from accounts payable list to vendor invoice and statement. It is ordinarily receive little attention because the primary concern is with understatements. For completeness, the objective is to make sure the existing accounts payable are included in the accounts payable. For common test of details of balance, the auditor can perform out of period liability tests. These are essential audit tests for accounts payable. For accuracy, the objective is to make sure the accounts payable in the account payable list are accounts. For common test of details of balance, the auditor can perform same procedure as those used for existing objective and out-of-period liability tests. Ordinarily, the emphasis in these procedures for accuracy is understatement rather than omission. For classification, the objective is to make sure the accounts payable in the account payable list are properly classified. For common test of details of balance, the auditor can review the list master files for related parties, notes or other interest-bearing liability, long-term payable, and debit balances. Knowledge of the client business is essential for these tests. For cut-off, the objective is to make sure the transaction in the acquisition and payment cycle are recorded in the proper period. For common tests of details of balance, the auditors can do tests for inventory in transit. These are essential audit tests for accounts payable. These are called cut-off tests. For obligation, the objective is to make sure the company has obligation to pay the liability included in the account payable. For common test of details of balance, the auditor can examine vendor statement and confirm accounts payable. Normally, not as concerned in the audit of accounts payable because all accounts payable are obligation. For presentation and disclosure, the objective is to make sure the accounts in the acquisition and payment cycle are properly presented and disclosed. For common test of details, the auditor can review statement to make sure material related parties and long-term and interest-bearing liability are segregated. Next is the analytical procedures for the acquisition and payment cycle. The first analytical procedure is compare acquisition-related expense, account balance with prior years. The possible misstatement for this procedure is the misstatement of accounts payable and expenses. The second analytical procedure is review list of accounts payable for unusual, non-vendor, and interest-bearing payable. The possible misstatement for this procedure is the classification misstatement for non-trade liabilities. The third analytical procedure is compare individual accounts payable with previous year. The possible misstatement for this procedure is unrecorded or non-existent accounts or misstatement. The last analytical procedure is calculate ratios such as purchases divided by accounts payable and account payable divided by current liabilities. The possible misstatement for this procedure is unrecorded or non-existent accounts or misstatement.
Here, 5 weaknesses and 5 possible effects of each weakness interface that may exist in the above purchase and payment cycle. The first problem are outdated vendor master list. The vendor master list is not regularly updated, resulting in inaccurate information, including inactive or duplicate vendors. The impact of the problems are have an errors in vendor selection lead to engagement with poor performing suppliers and production delays. As a result, the company ends up working with suppliers who fail to meet the quality standards or delivery timelines. This co-production slowdowns, increase operational costs, and can damage the company reputation with customers. The solution are conduct regular audits of the vendor master list to keep information up to date and accurate. Eliminate entries for inactive or duplicate vendors to maintain data integrity. Additionally, develop a formal process for systematically archiving all the vendor records so they remain accessible for reference without disrupting current operation. Second weakness, the company does not have a strong or systematic process to evaluate, track, and manage supply performance. Currently, suppliers are not regularly assessed using clear key performance indicator (KPI) whether on-time deliver, quality standards, or responsiveness to issue. Because of this, underperforming suppliers are not identified or corrected in time. The impact of the supplier performance is not properly monitored. The company keeps using suppliers who constantly deliver substandard goods or services. This leads to production stoppage when material arrive late or fail quality checks. These stoppages disrupt production schedule, delay customer orders, and increase costs due to emergency source, reward, or penalties. Ultimately, this reduces overall operational efficiency and damages the company reputation with customers. The solution is develop a supply performance monitor system that track KPI, review supplier performance regularly, and implement corrective action or replace underperforming suppliers.
Third possible internal control weaknesses is no comparison was made between the physical goods order received and billed. The lack of proper three-way matching, which are purchase order, delivery notes, and invoice, is major internal control deficiency. This control ensures completeness, accuracy, and validity of transaction before payment was made. In case study, Aisha prepared payment voucher based solely on the information provided in the goods of receipt note. Auditor must evaluate whether goods received are actually ordered and correctly billed. Possible effect is likely that the goods received does not match the order invoice. These weaknesses increase the risk of overpayment, duplicate payment, which directly contribute to the fraud risk and inefficient use of resources. To improve these weaknesses, the company needs to establish procedure to compare the goods received physically with the purchase order and delivery notes from the supplier. Next is possible internal control weaknesses is no segregation of duty between purchasing and task payment. In case study, Aisha was already partnered with the selecting supplier, was also responsible for processing payment once she received the goods receipt notes. This lack of segregation contract proper internal control practice, especially under pressure and tight deadline, and open up opportunity for unauthorized transaction. Impact of weaknesses to the company. This could lead to potential fraud and error, such as make a payment for a purchase that did not exist because there was no one else independently verifying the transaction. Aisha's action was trusted without review. This reflects a classic control weaknesses and high fraud risk identified in auditing standard. Way to improve is segregation the duties between purchase and payment. This will help ensure proper check and balance, reducing the risk if undetected fraud payment.
Last but not least, I will be highlighting the issue of payment delay caused by the director limiting availability to sign check. Currently, the company rely on the director physical signature for all check payment. However, due to the director packed schedule, this often causes delay in payment processing. This weakness poses several risks to the company. Most notably, it can lead to the missed payment deadline, supplier dissatisfaction, and even late payment penalty. Over time, such delay can damage the company reputation as friend-supplier relationship, possibly resulting in loss of credit term or supply disruption. To overcome this weakness, we recommend that the company modernize its payment system by transitioning to online banking or automatic clearing house transfer. This digital payment method allows for faster transaction processing, reduce the company dependency on the director physical presence, and offer better tracking and security feature. This change will not only improve the efficiency in the payment cycle, but also support stronger internal control and better accountability. In conclusion, addressing this internal control weakness by adopting more automatic and streamlined payment system can significantly enhance the company operational efficiency and vendor relationship. It's a practical towards improving both control reliability and timely financial commitment. Thank you.